Good afternoon, everybody, and thank you for joining us this afternoon. My name is Ian, and I'm with Softrex. We're happy to be joined by our partners over at CBIZ for a presentation this afternoon. So before we start, as we still let a few people trickle in, I would just like to run through some CPE housekeeping type stuff fairly briefly. As you hopefully know, this is a CPE eligible webinar. In order to qualify for CPE credit at the webinar's conclusion, please make sure that you participate in the 4 polling questions that will be interspersed throughout the presentation. You'll be able to answer those questions through the GoToWebinar console on the right side of your screen. Additionally, please make sure that you stay for the full duration of the webinar in accordance with the CPE requirements. And at any point, if you have any questions, please feel free to use that GoToWebinar question box to submit the questions. At the end, there'll be time for questions. We'll make sure that all questions are answered, and if there are too many questions to answer in the allotted time, we'll make sure to follow up after the fact to provide those answers. For all of those of you who choose to participate and are CPE eligible at the end, there will be no action required of you to receive your certificates. Those will be automatically distributed via email after the fact. And at the webinar's conclusion, there will be a really brief survey, just a 5-question multiple choice survey that pops up in your console after. If you don't mind participating in that, it would, those greatly help us to improve the content going forward. So with that, I can go ahead, and I'm happy to introduce our panelists for this afternoon. We have a great panel for you. I'm joined from Softrex, Tom Zolli, our Senior Vice President and General Manager, and also by Vineet, Jain, and David Lewin from CBIZ. So I can turn it over to David, and I believe he has a little bit of an introduction on CBIZ itself.
Thank you very much, and thanks everybody for joining the call today. We really are happy that all of you have joined. So I'm Dave Lewin. I run the accounting advisory practice at CBIZ New England. And in short, we help our clients with anything and everything that would flow through a traditional controller's office, from as simple as accounts payable and payroll all the way to obviously this ASC 606 implementation. We do IPO readiness, we do outsourced controller work. Again, really anything on the accounting side that flows through your traditional controller's office. And CBIZ, we are a top 10 accounting firm. We have offices nationwide, and we have audit practices, tax practices, both consulting as well as, for the standard tax returns. But we've also got an insurance division as well as benefits consulting and payroll. So we really do a whole host of different things. But for today, we're going to focus on the accounting side as it relates to 606. And with that, I will introduce to you Vineet Jain, who's a director in our group.
Thank you, Dave. Hello, everyone. A very warm good afternoon to you, everyone. I am a director in the accounting and advisory practice. I have over 20 years of experience in financial leadership roles in public and private companies, as well as public accounting. I joined CBIZ and MHM from Parexel International, a global biopharmaceutical services company, where I was the revenue controller. As a revenue controller, I led the global revenue team responsible for the implementation of the ERP system for ASC 606 adoption and the compliance of internal controls over financial reporting. Ian, do we want to start with the first polling question?
Yes, we certainly can. I'll go ahead and I'll advance it 1. And Tom, if you'd like to say a couple of words about it.
About the polling question itself, so the question is fundamentally, where do you stand in terms of ASC 606 adoption? Whether have you not adopted yet? Have you adopted portions and are processing manually? We're trying to understand if you've adopted portions and processing fully automatically, and then same questions regarding the full guidance and whether you're processing manually or fully automatically. We'll wait and see how the responses come in. We'll give you a minute here to respond. While people are responding, I will say that we have certainly seen an uptick in people that are, I would say, not necessarily adopting, but operationalizing the guidance. So these would be companies that adopted, over the last, let's say, 12 or 18 months, and they're reaching limits on the spreadsheets or whatever that they're using, and giving us a call basically. So it was quiet a little bit over the summer, and then started to spike up again here in the fall.
Looks like we're at about 90% of votes in. So in another few seconds, I'll just go ahead and close, and I will post the results.
Yeah, so that not unexpected. I think David or Vineet, certainly weigh in, but we still see between lines 2 and 4, what is that, about 60% have adopted and processing manually, and then another 16, so probably 75% of people haven't automated yet, which is not too surprising.
Yeah, this is very much in line with what the array of our clients, when a lot of our tax and audit clients as well. This spread is very much in line with what I'd expected to see.
Yeah.
Okay.
So, all right.
Okay, thanks for that polling question. So moving on, as we all know, this ASC 606 is a 5-step process, right? And but today we are planning to cover only 3 topics from ASC 606, as probably we would need many hours, if not days, to get through everything. So the 3 topics which we will cover today are variable consideration, right to invoice practical expedient, and commissions. These are the topics which we found are most relevant to private companies, and hence we chose this topic for today. So variable consideration. In this section, we will discuss variable consideration from the 3rd step of the revenue recognition method, give examples of the 2 methods to estimate it, and describe how to determine if there is any constraint. Generally, we found that one way variable consideration has helped companies with their bottom line is that bonus penalties, which was required to be booked in full when received or determinable respectively, are now required to be recognized over the term of the contract. This is due to the fact that they are required to be estimated and adjusted in the transaction price upfront. Variable consideration, as it is defined, the transaction price as the amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods and services. The transaction price may include fixed and variable amounts, and the company is required to estimate the amount of variable consideration. Now, the variable consideration may be explicit or implicit in the contract. For example, bonus and penalties are explicitly stated in the contracts, whereas price concessions or volume rebates are implicit in a particular industry under certain circumstances. But all of these are to be factored in the transaction price upfront. In limited situations, an entity may not be required to estimate the amount of variable consideration. A couple of examples are when the entity applies right to invoice practical expedient, which we will discuss in detail in subsequent slides, and the entity allocates entire variable consideration to a distinct goods or services that forms part of a series. Now, question may arise, is consideration variable even if price per unit is fixed, but the units are variable? The answer is yes. The transaction price would be variable if the nature of the promise is to perform an unknown quantity of task throughout the contract period, and the consideration is contingent on the quantity completed. The entity will have to use one of the 2 methods explained in the subsequent slides to estimate variable consideration. But even after applying one of the two methods to estimate the variable consideration, entities must overcome one or more hurdle. The consideration can only be included in the transaction price to the extent it is probable that a significant reversal will not occur. And note over here the word significant reversal will not occur. Now, probable is defined as likely to occur, which is a little higher standard than more likely than not, or in other words, more than 50%. Making this determination involves significant judgment and must include assessment of both the likelihood and the magnitude of the potential revenue reversal. So I repeat, this requires significant judgment on the likelihood and the magnitude of the potential revenue reversal. The process does not have to be separate from the estimation of variable consideration, but all principles of the constraint must be considered. Now, getting into a further detail on magnitude versus likelihood, the magnitude criteria plays a bigger role as the size of the potential reversal increases relative to the contract. As the magnitude of the consideration increases, management must have more substantive support for its assertion that the potential reversal is not probable. Now, the standard does not provide any percentage thresholds on what is considered probable or significant, but I can give an example which can explain this concept. If a contract includes variable consideration that is not significant to the rest of the contract, and the variable consideration is between 70 to 75% likely not to reverse, a company might conclude that a year of experience with similar contracts is adequate to support the conclusion that such amount need not be constrained. On the other hand, if the variable consideration accounts for 25% of the contract value, the company would likely need more extensive experience with similar contracts to support the inclusion of that amount. So there is as you can see, there is a lot of judgment involved over here. Again, a question may arise, should the constraint on variable consideration be applied at the contract level or performance obligation level? The answer is at the contract level. In other words, when considering the magnitude of the potential reversal of variable consideration, the assessment should be based on the total consideration of the whole contract and not just the amount of variable consideration or the specific performance obligation. There are certain factors that increase the probability of reversals of variable consideration, which could be, for example, the consideration is highly susceptible to the factors outside of entity's influence, or the uncertainty is not expected to be resolved for a long period of time, or the company may not have a lot of past experience or evidence dealing with similar situations. There could be a broad range of possible consideration amounts, and sometimes a legal and regulatory environment could also impact the likelihood and magnitude of the potential reversals. Moving on to the next slide, there are two methods to estimate variable consideration. But note that the method used is not an accounting policy election. Rather, the company must determine on a case-by-case basis which of the two methods is most appropriate given the nature of the variable consideration. So the two methods are most likely amount method or the expected value method. Now, in terms of the most likely amount method, this method works well in situation when with only two possible outcomes. If only two real possibilities exist, using an expected value approach would likely result in a transaction price that is significantly different than either of the two possible outcomes. In such cases, the most likely method will be more appropriate because it produces a better estimate of the consideration the company expects to receive. But this method may be hard to apply when outcome is not significantly more likely than the other, when one of the outcome is not more significantly likely than the other. A thing to note over here is that there are recent comment letters from Securities and Exchange Commission, SEC, which have asked companies to explain their application of the amounts when they are using most likely method. So you can imagine that the auditors will put more scrutiny when you use most likely method. Now, in terms of expected value method, this method is carried out by finding a range of possible consideration amounts, weighting those amounts by the respective probabilities, and then summing up the probability weighted amounts to generate a single number that represents the expected value of the consideration to be received by the customer. Let me give a quick example. An entity A enters into a contract to perform a project with customer B. When entity A completes the project by deadline, it will receive, let's say, $500 in consideration. And entity A will also receive $50 on compensation for every business day ahead of its deadline. For example, if entity A finishes week ahead of schedule, it will receive $250 in extra compensation. Now, based on its past performance in the similar contracts, entity A estimates 30% likelihood of finishing on the date scheduled. It expects 50% likelihood of finishing a week ahead of schedule and a 20% likelihood of completing the project 2 weeks ahead of schedule. Now, if we were to use this probability on the $250 in compensation, then entity A calculates the following probability weighted amounts, as you can see in the screen. Summing up these probability weighted amounts will be $725 as the total transaction price. You may wonder, can the most likely amount and the expected value approach be used in the same contract? The answer is yes. They may be applied separately to different sources of variable consideration, but not to the same source. For example, if a contract concludes that both bonus for early completion of the project and a quality bonus if a project exceeds certain expectations, then the company may use the expected value approach for the early completion of bonus, as you've seen in the example we just saw, and the most likely approach for the quality bonus. Note that you cannot apply both methods to the same source of variable consideration within the same contract. Now, moving on to the next slide. Now, the variable consideration can come in many forms, such as discounts, rebates, refunds, credits, price concessions, incentives. In the table, we have indicated most commonly used methods to calculate variable considerations. In conclusion, I would say that estimating variable consideration requires significant judgment by the preparers. ASC 606 requires companies to include variable consideration in the transaction price of each contract only to the extent it is not probable that a significant reversal of revenue will occur. Companies are required to determine both the likelihood and the magnitude of the potential reversals to correctly determine what amount should be constrained. The constraint requires a lot of judgment, more specifically when variable amounts are near the probable threshold. And as with everything else, note that additional disclosures are required in the financial statements on the nature of variable consideration, methods used to evaluate them, and how constraints were dealt with. Now, moving on to the next slide, CBIZ has developed a binary method to implement when accrual should be made for variable consideration when using the most likely amount method. This is more relevant when there are numerous projects being serviced by the company simultaneously, and you want to adopt some standard way of applying judgment to all those contracts. The interpretation of the overall output of qualitative assessment could be one, which is a positive change to the revenue, negative, which is -1, which is a negative change to the transaction price, or 0, which implies no change to the transaction price. We will see this in the next slide. Now, if anyone in the audience is interested to explore this further, we can surely go over this in more details towards the end of the presentation, because this is probably not applicable for many of our many in the audience, because not many people deal with multiple contracts at the same time, which requires judgment on most likely method. Now, before I hand over to Tom to provide some perspective from Softtrack's, Dave, do you have any practical examples you would like to share?
Sure. Thank you, Vineet. So Vineet and I worked on a client earlier in the year, and they were essentially a beverage contract manufacturer and bottler. And they contract with a number of extremely large beverage brands. And it was interesting. There were all sorts of elements of variable consideration in their contracts. So, for example, if the beverage manufacturer failed to provide enough run or a specific amount of line time, they had a number of different production lines. If they were unable to provide a certain amount of line time, there would be a contract penalty in the form of a reduction in cost per case. And then on the flip side, if they were able to provide additional line time in the event the client needed it, they could earn, for lack of better words, a bonus or an increase in the cost per case. So the company had to go through contract by contract and figure out, if they were going to be using extra lines for one contract, but at the detriment of another, they may earn a bonus in one place and not the other. So it was a pretty tedious exercise to go through, but they did it. And they also had, there were other ways they could receive additional bonuses. So as far as there were just certain criteria about the manufacturing facility that if they hit certain thresholds, they could get additional bonuses. So that was one example. And then we had another client whereby it was a long-term contract. It was a 4-year contract, and the company was essentially installing doors and locks and electric alarm systems at a university in multiple buildings. So to the extent that my client was able to get all that work done in a faster time period, they would earn a bonus. So what they had to do is they had to really take a step back and figure out how quickly did they think they could get it done, how would that translate into the bonus, and then accrue that bonus ratably over time, and they would fine-tune their estimate every reporting period. So those are just a few examples of variable consideration and how in the olden days you would just wait to the very end to book those things, but now the new standard is making you book that up front or consider it up front.
Oh, that's great, David. Thank you for that example. I think from our perspective, VC is it's a good example of what we're seeing in the market. So, as people start to operationalize the guidance, I mean, what they want is they want to keep the back office agile, and they want to keep it automated. And the problem that we're seeing companies have, and COVID actually accelerated this to some degree. As companies change their contracts, as they change their billing models, one of the interesting things about ASC 606 is that you could have, a relatively, minor change to a contract, but it actually ends up being an explosion of complexity when you turn to the revenue recognition. We see it the classic example is, with COVID is that, companies are really reconsidering recurring revenue models because of the stability that companies that had those models saw during COVID as opposed to others that didn't. And when you make that transition, particularly if you're falling under the allocation guidance, now all of a sudden you're probably into contract modifications and combinations. For those special cases of recurring models where people are moving to consumption-based billing, one of the things that's been burning everybody is variable consideration and how to automate that, and how to automate the the revaluation of variable consideration over time. So we have built out infrastructure within our solution that enables us basically to deploy in a multi-tenant cloud, which just seems like what everybody wants, but be able to handle some of these complexities. I mean, some of them obviously out of the box, but in terms of the revaluation of variable consideration, and I see it sometimes in the contract modification guidance, there are particular processing flows that companies need that are business specific in some ways, and to be able to handle those as well without the need to customize. So, my fundamental message would be, if you're in a business where you think you're going to undergo change, sometimes RevRec is the last thing to be thought about, but there are some monsters lurking in the guidance that you need to pay attention to, because they could have a big impact on how you recognize revenue. Okay, and I see we're on polling question 2. So this polling question 2 asks, how is your company current handling or planning to handle the requirements of 606? And the options, the usual ones: Excel, an ERP system, point solution, customizations, or unsure. We'll give a few minutes to answer. I mean, I think from the first question, and it sounds like, David, you agree, but it sounds like a lot of people are processing manually, which probably implies, a lot of work in Excel. One observation that I've had recently that I think is interesting is this guidance comes, roughly when people are making a big push into switching over to sort of either a cloud platform or point solutions in the cloud. And I never thought the option of customizing was a good one in the past, for lots of reasons, including vendor version lock-in and stabilization of the application and things like that. But that option is kind of going away. So it'll be interesting to see how many people are still able to customize or probably want to customize in the answers here. So
yeah, and what I've seen is a lot of publicly traded companies who are on very large ERP systems. So for example, Oracle NetSuite, they typically use the Oracle NetSuite 606 module, but everybody else is either on a system like yours or yes, still living in Excel land.
Yeah.
Great. So it looks like we're up over 90% voting again. So just another couple of seconds and I'll close it and share the results.
Just one last comment on, while we're waiting for this to close up, on variable consideration. From a technical guidance perspective, companies are required to update their assumptions that they've made under variable consideration at every reporting period. So if you're a publicly traded company, you obviously would know this because you're under 606 today. You're updating those assumptions every single quarter. For private companies that are issuing an annual set of GAAP financial statements, typically they'll update those assumptions either when the contract is completed, if before year end, or they'll do a big update at year end. To the extent that private companies can put into place quarterly or semi-annual procedures, that's great. But we typically see, because there's no GAAP reporting requirement till year end, that they're updating those major assumptions at year end, so they have more historical information.
Yep, not too unexpected here. So yeah, a lot on Excel, good portion on ERP. Not as much on point solutions as I sort of expected, but the customization is in line. I think we'll see that number go down over time. I mean, fundamentally, I think that there are plenty of ways to misstep, get caught into a solution structure that can't handle some current or more likely future need. but I do believe that it's possible to deploy to cloud and maintain the flexibility and agility. I just think you have to be very careful about how you do it. So.
With that, we move on to the next topic, which is one of the most overlooked yet practical solution to many revenue recognition issues. The change from rule-based, industry-focused guidance to one-size-fits-all, principle-based standard has resulted in significant changes to how companies account for their contracts with customers. Now, depending on the facts and circumstances, some entities may find it complicated to implement the new revenue recognition guidance. But to help simplify adoption effort, FASB has allowed for the use of certain practical expedients that private companies can elect for their ASC 606 implementation effort. And of course, this can also be adopted by the public companies as well. Now, this practical expedient, the next slide, please, are designed to make it easier to transition to and comply with the new standard, but they do come with some certain considerations. When your organization elects to use practical expedient, it will be required to use it for all applicable current and future contracts. So you cannot pick and choose. So for example, if you have a certain revenue stream you have identified, all contracts have to be under right to invoice practical expedient if you choose to adopt that, but you cannot choose some and choose other under a different approach. The adoption of a practical expedient may require additional disclosures to illustrate the judgments used in the applying of the practical expedient. And the practical expedient options can help reduce the burden of transition and make it easier to comply with the requirements. And we will see that in the next slides. Now, ASC 606 states that the entity shall recognize revenue over time first, and only if that is not met, that you have to recognize at a point in time. But when you are recognizing revenue over time, by you are basically measuring the progress towards complete satisfaction of that performance obligation. For all contracts that fall under this category, the gap basically outlines two acceptable methods for measuring progress towards the completion of the contract and to determine when to recognize revenue, the input method and the output method. And both these methods are acceptable, but they are not interchangeable. So again, consistency across the contracts or the revenue stream is important, and you just cannot mix and match between the revenue stream. And the method chosen must be appropriate for the circumstances of the contract. So again, it is not a accounting policy choice, but it has to be based on judgment and consideration of the facts of the contract. Now, moving on to the next slide, right to invoice. The output method measures the result achieved and the value transferred to a customer. In certain circumstances, a special output measure, which is the practical expedient that allows revenue recognition based on amount for which the entity has the right to invoice, may be applied. Now, this method is often preferable due to its close correlation with substantive performance of a contract. This is often applied to service contracts in which invoices to the customer align with the amount of value delivered to the customer. Now, an entity may elect to use this practical expedient only if it has a strong evidence demonstrating that the amount invoiced directly corresponds with the value to the customer of the entity's performance completed to date. So basically, what, in other words, if your performance obligation is reflected in the invoice of all the work completed to date, you can use this practical expedient. Now, what are the certain highlights of right to invoice? Now, organizations that use practical expedient will recognize revenue by multiplying price assigned to the goods or services delivered by the measure of progress, like, for example, units transferred or quantities delivered. Therefore, you can effectively bypass the steps of determining the transaction price, allocating the transaction price to performance obligations, and determining when to recognize revenue. So in a sense, you can be bypassing steps 3 to 5 of the 5-step revenue recognition approach if you adopt this practical expedient. And that is why we say that this is a very simplified approach to revenue recognition. However, the practical expedient does not permit an entity to bypass the requirements to determine the performance obligations in the contract and to evaluate whether the performance obligation is satisfied over time. So you just cannot determine that the performance obligation will be has to be recognized at a point in time. You still have to evaluate whether all the criterias or one of the criterias for overtime has been met or not. Now, applying the practical expedient and using this output measure might be common in situations where the customer is invoiced a fixed amount for individual units delivered or hours of services rendered. In other words, the most common examples are time and material type contracts. As reflected in this slide, there are few things to note. Application of this practical expedient is limited, and entities must be very careful in evaluating whether this practical expedient applies to them. And because again, if you adopt right to invoice practical expedient, it may not apply to all of the entities' performance obligation. So definitely there is a lot of judgment involved whether this right to invoice practical expedient is applicable to the entity. Hence, we strongly encourage the entities to consult with their auditors if they are considering applying this practical expedient, because you don't want that the auditors come in the last during the audit after you have closed your books to say that this was incorrect application of right to invoice practical expedient. Now, there are certain limitations about this when to apply the right to invoice practical expedient. For example, in cases where outputs are very difficult to observe, as often is the case in service projects or long-term projects, then it is very difficult to apply the practical expedient, or a project which results in work in progress, because that is the work in process. The work in progress is basically the unbilled portion of your work, and because you are not invoicing it, it is very difficult to apply the right to invoice practical expedient. Or, for example, in cases where you have billing rate changes throughout the life of the contract, but if you are able to prove or demonstrate that the changing rate reflects the value received by the customer, and the rates are basically indexed to, let's say, inflation or some other market factors, then you can still apply the practical expedient. If you have some minimum payment clauses in your contract, then you might find it difficult unless you are able to demonstrate that you will always exceed the minimum amount in the contract, in which case you will be able to apply the practical expedient. In situations where you have upfront or back-end payments, you may not be able to apply practical expedient unless they are immaterial amounts. And but the whole point is that we are trying to establish that the amount we invoice to the customers is basically reflecting all the work we have done till the end of that month. If you are able to clearly articulate that, then you are able to adopt this practical expedient and make your revenue recognition process a very simple one, because you only have to do step 1, step 2, and then just determine whether you meet the criteria of overtime recognition criteria or not. Now, before I hand over to Tom to provide some perspective from Softrex, Dave, do you have any practical examples you would like to share?
Sure, I'll give one example. Another client we had performed services at the airport. So they essentially provided people to unload the planes, clean the planes, prep the planes, and there are varying rates per person per task. And in this case too, there was the ability to achieve bonuses based on the turnaround time when a plane comes in and then the plane comes out. So what seemed like a relatively simple business actually had some pretty complex revenue, but we were able to work with the client to adopt this practical expedient right to invoice, because ultimately on a monthly basis, any of those performance bonuses were being calculated on a monthly basis and billed and paid, and there was no true up at year end if over the course of a year, they ended up not hitting those turnaround rates on an annual basis. And all of the services being provided and the different rates were the prevailing rates. So we made what could have been a very complex situation relatively simple for the client, and then assisted the client in walking through all of our assumptions with their auditors. So it was really a huge win-win for the client, and then I guess in theory for the auditors, because it made it much easier to audit. So that's my one real life example.
And to add to that, I was part of that project as well. Definitely, there was a lot of disclosure requirements, and we had to basically explain out why we are able to use the right to invoice practical expedient and what we did with the variable consideration, because as we mentioned earlier, you don't need to estimate variable consideration because they are being done on a monthly basis. And so we had to disclose all that in the financial notes to explain the adoption of this. And the client was very happy in the sense that this didn't result in any adjustment to their opening balance sheet when they adopted, when they used the modified retrospective method, because in effect they were able to see that they fully adopted with full retrospective effort, because there was no change in revenue recognition method from the prior years. So that was a very good example of when to apply this practical expedient. Over to you, Tom.
Okay, thank you, Vineet. Yeah, I think that thinking about it from an operational perspective, I think that we've seen situations where the desire to automate, or the result of automation is very much a black and white type of thing, meaning that a lot of companies feel like they can't fully automate. They have at least some work in spreadsheets, even if they're automating some part of the guidance. And what I would say is that the reality is there's a magical moment if you get to full automation. The world is a much better place than if you were sort of partially automated, because those spreadsheets that exist for those sort of key processes or complex processes, they can really limit the value you get from the automation. So, and there's levers that you can pull. So I mean, if you're working with a good advisory firm like CBIZ or the firms that are out there, they're aware of these practical expedients, and right out of the gate they can simplify your life. Two, some of the tools, and I'll speak to Softrex. I mean, we've spent a lot of time focusing on the last 10%, basically, which means, okay, we're automating all of the key processes. Let's say you can't use a practical expedient and you do have to fall back to some method like percent of transfer or whatever, making sure that you can still automate it, even though it might seem complex, and even though it might seem like doesn't lend itself to automation. Our experience has been that usually it does. I mean, between a combination of the right advisory firm and the right technology, you can get to the automation. In our case, we actually do a lot of work with a company called ChangePoint. We've been partnered with them since 2003, and it's really pushed us to look at the entire fulfillment integration point and taking in data that represents how value is being transferred and being able to deal with it in a very automated way to drive the recognition of revenue. So, I'll leave it with that. I mean, I think those are the major levers. And looks like we're on polling question number 3, which I'm very interested to see the results on this one. It asks, which ASC 606 disclosure requirement is most challenging for your company? Disaggregation of revenue, presentation of contract balances, transaction price allocated to remaining performance obligations, significant judgments, so determining the timing and satisfaction of these obligations, or determining the transaction price and the amounts allocated to the performance obligations. And we'll give you a few seconds to answer this one. My experience, David, I don't know if you'll agree, I find that the allocation process itself is creating problems for companies, particularly when you get into stratification of standalone selling prices and some of the complexities there.
Without a doubt.
Yeah.
The good thing is for private companies, my hunch is most of the folks on the phone, this is just a hunch, that are probably private companies, the disclosure requirements are significantly reduced.
Yeah.
Which is very helpful. But yes,
yeah, I would agree. Yeah.
Yeah, and even the contract balances are not that difficult if you are not using percentage of completion method. So if you are just have time and material type contracts, the contract balances are straightforward. What makes it complex is, I guess, the judgments over material rights and things like that, which again, I'm not sure how many companies will have those elements.
Right. Yeah. Okay. So the allocation one is the larger even in this audience, which is interesting. Yeah, I mean, pretty much as expected. It's almost an even split, but allocation looks like it came out a little bit on top there.
Yeah, I think transaction price allocation becomes a challenge because of the fact that you have to determine the standalone selling price, and sometimes that's the big area of judgment, right?
Yeah.
As well.
Yep, totally agree. Yep. Okay,
moving on to the next topic, commissions. Now, if the requirements of ASC 340 to capitalize sales commission to obtain a contract are met, such accounting is not optional. So commissions is very much like accounting for the commission in the right way is very much a requirement, and the entity does not have an accounting policy election to whether to capitalize or expense commissions. The only exception is the practical expedient related to commissions with an amortization period of 1 year or less. So only when you have a commission period of 1 year or less that you can expense it. Otherwise, pretty much you have to follow the guidance under AC 340. So now, when the capitalization is required, the company may elect to use the practical expedient, as I just mentioned, only if the amortization period or the contract period is 1 year or less. So, in other words, if the commission costs are incremental, they are expected to be recovered, and the amortization period is more than 1 year, you have to capitalize the cost. Now, the calculation is required when commission rates on renewal is different than the initial year, and judgment is required to determine the contract life over which to amortize the cost ratably. For example, if you have a commission structure which pays an employee 5% commission for obtaining a 1 year contract, and it goes down to 2% on renewal, then the entity has to determine the amortization period, use a judgment on what will be the contract term, and then basically amortize this commission ratably over the contract term, which could be again, a 30-month contract or a 24-month contract based on your past history with that customer. So again, the key point over here is that if your contracts are less than 1 year, then you can apply the practical expedient. Or if your commissions are same on the initial year and the subsequent year, that means there is no change in the commission structure, then of course you can expense it as you incur, because there is no change. You will still get the same result when you amortize that ratably over the contract. In the next slide, we will see I have tried to list out certain examples of cost and how to deal with them under ASC 340. For example, commissions paid only upon successful signing of the contract. And so this was a incremental cost, and which is available to the employee only when they sign the contract. Now, so in this case, you have to capitalize the commission. But salaries for the salespeople working in the team, you will generally expense, because that you have to incur whether you sign a new contract or not. And also, so in this case, you have to expense it. And commissions paid to sales manager based on contracts obtained by his direct subordinates. Again, you have to capitalize that, because this is based on new contracts they are getting signed. So now, before I hand over to Tom, Dave, do you have any things to share on the commission?
Yep. So I'm going to give you a relatively extreme example. We were hired by a company that, when you go into an office building, you see those little TVs and they're running advertising and whatever else on those TVs in the elevators. And they essentially signed 10-year contracts with landlords for essentially the installation of the equipment and the streaming media, if you will. So, and in that case, all of their salespeople earned a commission every time they sold one of these contracts. So we're talking about a 10-year contract. So when this company adopted ASC 606, they had to go and determine all of the active contracts, so the contracts that were still in force over the past 10 years, and determine or estimate. In our case, we estimated, what was the estimated commissions paid on those contracts, because historically they had been expensing the commissions as incurred. So when they adopted 606, we had a huge adjustment to essentially put deferred commissions back up on the balance sheet and amortize them. So it's an extreme example, but I think it really illustrates the point, in that when you pay sales commissions and the contracts are greater than a year, those need to get put up on the balance sheet and then amortized over the life of the contract, including estimated renewal terms. So that was just one kind of extreme but good example that I think demonstrates the commission accounting.
Thanks, Dave.
Yeah, that's a good example, David. And just a curious question: have you or Vineet, have you run into situations where the average life of the contract changes at a point in time, and there is actual revaluation of some of the in-flight commissions against the new life?
Definitely, this is one area where a lot of judgment is involved, and as the company matures through their product life cycle, they will have to reevaluate the contract terms more often, and most importantly, the auditors will point it out when they see some changes in the behavior of the customers.
Gotcha. Okay. Yeah, that's interesting. I've only seen it a couple of times so far myself, but that's interesting. So, from an operational perspective, I think that there are a lot of people trying to automate this. Full disclosure, we currently don't have functionality that helps you calculate the commission, meaning, these guys should get this percentage of this deal and things like that. The farthest we go is reports that we write. They're usually custom reports for particular companies that leverage the data that's in the revenue database and construct the initial commissions. Having said that, we do manage the deferral of those capitalized costs over time within our subledger. So in that way, we support 340. I asked the question on the change in life, and I've seen this not just in commissions, I've seen it in other areas as well, but I think that one of the nice things in moving this out of spreadsheets and into sort of a systematized database is that if you do need to take action against a large set of transactions, so in this case, if you have a bunch of costs related to commissions that you're capitalizing and they're running out over time, over the the customer life, if you will, or the contract life with renewal terms, and you reevaluate that term and you want to recast everything that's in flight, that's already existing against that new term, one of the nice things that we and maybe possibly other vendors have is a bulk post-processing feature, which lets you say, okay, I want you to take these 300 contracts, and instead of having them run out over, let's say, a 3-year period, I want them now to run over a 3-year and 9-month period, or a 4-year period, or something like that. So yeah, I mean, that's basically my comment from an operational perspective. But I definitely will say that this question comes up a lot. It seems like people are really struggling with this portion. So obviously there's some pain points there. So okay, that leads us to polling question 4. So another good question here actually. So what are the major business implications of implementing ASC 606 for your company? Is it the complication of the revenue treatments themselves that are causing disruption? Is it separation of order to cash and order to revenue, which I know is new for a lot of companies, or was at least, non-standard business practices, or the disclosure aspect of it and dealing with all the new disclosure requirements? David, I'm interested in Vineet in your thoughts. I will say that second one, separation of order to cash and order to revenue, that's been problematic for a number of the CFOs and CAOs that we speak to, because their existing systems in many cases aren't designed for that.
Yep.
Yeah, and that was one of the reasons why we had to, at Parexel, we had to implement a whole new ERP system just for the adoption of ASC 606, and that was a huge project over 4 years. Wow, just for ASC 6, that's interesting. Yeah, I mean, ASC 606, it breaks most of the existing ERP systems I'm aware of, because most of them were designed to trigger RevRec off the generation of the invoice. So, I mean, I would think it would be broken for 2 reasons, right? I mean, if you have any kind of contract asset position, then it's very hard to manage that. And then, passing TCV, total contract value, to do allocations, if RevRec occurs off the invoice, I'd imagine that would be pretty hard as well.
Yep. So I know we're getting real close to so first and foremost, I wanted to thank everybody for joining today. Hopefully this is super helpful. From a CBIZ perspective, if you are still in the process or haven't started the process of doing your ASC 606 assessment, Vineet leads our revenue team, where we come in, we have a great little tool where we take a look at your contracts and really assess what the standard means for you, so that you can then take a step back and say, okay, it doesn't mean much, I can keep doing it with my current systems, or oh my gosh, it's going to have a material impact on how I record revenue, and I need a software like a Softrax, or maybe something in between. And then the other thing we always offer to our clients is, if they're thinking about coming up with new contracts, or what contract language can be tweaked in your current contract templates that will help you get to the revenue recognition that you'd like. It's always better to get the contract language right up front than realize you've got some language in there that's putting you in a bucket you don't want to be in. So we've helped lots of clients think about how they want to word future contracts, or potentially change wording in existing contracts when those come up for renewal. So with that, any questions from the audience?
We are just at that end right there. So I think that we might be better off served, like I mentioned in the beginning, if we just collect a couple of the questions and we can send them out after, distribute them after.
Got it. Sorry about that. Yep.
No, it's
all right. Well, thank you guys so much for
Thank you.
joining us, and thank you, David and Vineet, for helping put off a great webinar. I appreciate it.
You got
Yeah,
it. Thanks,
thanks a
guys.
lot.
Thanks, everyone.
Thank you.
Stay healthy and safe.
Yeah.
Bye.
Bye.